We have Dan Ives, Wedbush Managing Director and Senior Equity Analyst, joining us on the phone. Dan, it's good to talk to you here. So I know you lowered your price target to 215 from 225. Obviously, the margin profitability story here is front and center.
Look, I think it's a tug of war in margins versus volume. And no doubt, I mean, margins under 20% auto gross margins missed the street by about 170 bips. That was a disappointment. And ultimately, they're ripping the Band-Aid off, cutting prices to stimulate demand. Everyone knows that. But there's a tightrope that they're walking right now, and the street did not like what they saw in terms of margins. Last thing you want to see is Sweet 16 margins.
Are they, Dan, emulating kind of the Amazon model, if you will, and do you think that can pay off down the road?
Yeah, I mean, they are taking a bit of a page out of that Bezos Amazon model. I do think the difference here, I think 80% of it is coming from a position of strength because they have the scale and the capacity from a battery technology, from a delivery perspective versus competitors across the board. But then there's also a piece that's stimulating demand based on a softer macro. And I think this is just an important balance because part of what makes them the gold standard is that margin level with growth. And if you continue to see compression there, that would be a worrying sign that would keep investors up at night.
Well, Darren, we're looking at the stock falling just over 10% today, 161 a share. How much of this worry do you think is priced in, reflected in today's drop? And what happens? Do you think there's more price cuts potentially ahead?
But I think there's probably 1 to 2 more smaller price cuts. So I think that's something that the street now expects. But I do believe we're starting to get into what's really a moment of truth next few quarters. You know, can they maintain 35-40% growth and margins being in the high teens? I think if you see margins 18-20% as it ultimately ramps back to low 20s, that's fine. But it's very important that it doesn't go below that threshold because then it really starts a cascade effect that would be a worrying sign for the stock, with a lot of that starting to get priced in terms of this sell-off.
Now, obviously, those margins still far greater than their competitors in the space. But on the other hand, their competitors spend north of $2 billion a year annually on marketing. And I'm talking about GM and Ford. Well, Tesla continues to spend goose egg, zero. Would you like that to change?
I think you'd like to see that change just because as the EV arms race plays out, I think that's something that they're ultimately going to have to pull that lever. And they haven't had to do that because they're the only game in town and they're miles and years ahead of competitors. But when you have that 313 area code, you look at what Mary and GM and Farley and Ford are doing, see what's happening in Europe. You got pure plays across the board. And also don't forget what's happening in China. I mean, I'd say the biggest price war right now is not here domestically, it's actually in China.
Dan, the growth, though, that might be ahead for China, is that enough really to maintain the momentum that Musk would like to see from Tesla, not only this year, but into next year as well?
Yeah, I mean, look, China is the hearts and lungs of the Tesla story. And that's why they can't just sit there if there's a price war and maintain their prices. And I think that's something that share gains have been there in China, but no doubt, I mean, you are seeing a price war basically break out in China, and Tesla obviously has to respond. But then it comes down to, okay, margins, what that level looks like. They're so far ahead of the industry. But the last thing you want to see that do is that gap narrows, because that's key to the multiple, and that's ultimately key to the sort of gold standard that Musk and Tesla have set.
Tesla's market share here still at a just insurmountable 58%. Has that number forever peaked?
Look, I don't think it's necessarily peaked because of where we just see broader EV demand going. But in terms of competition, whether it's in China, Europe, US, I mean, this Game of Thrones is just going to get more intense. And I think that's ultimately why Tesla recognizes sooner rather than later near-term pain, long-term gain. In other words, put the iron fence around the install base, and then ultimately we'll sell more software into them, whether it's FSD and others. That's where the margin leverage will be. And that is the smart poker move, but it's about the balance. Because it goes back to, if there's a T-shirt that's $50, next week it goes to $40, next week it goes to $30. Are you going to buy it? No, because you assume the following week it's going to go to $20.
That echoes what Ross Gerber told us yesterday, creates the wrong type of consumer behavior. Interesting to hear you say that. Dan Ives from Wedbush, great to talk to my friend. Enjoy the weekend.